green on the screen is holding on. Let's take a look at the broader markets because they were the key underperformers. Whether they are holding in the green, underperforming, or managing to hold on, they're managing to hold on again of around 1.5% on both the mid cap and the small cap indices. But is that the case only for today, or is the worst over? That's the question we'll pose to Jyotivardhan Jaipuria. He's joining us as the founder and MD at Valuations Advisors. Mr. Jaipuria, hi, good to be speaking with you. That's the first question. Do you think the poison is out of the system and one should start deploying? Or this was just scratching the surface and there could be a lot more as far as downside is concerned on individual names from the broader markets?
Yeah, so if you look at a very broad market, after quite some time, valuations are reaching what I would say they're not cheap, but they're getting somewhere where you can say, okay, they're getting towards the top end of the fair value zone, especially for the large cap. So if we just see the large cap universe, it's trading at close to 19 times 1 year forward now. And if you look at the 10-year average, it's around 18.3 times. So somewhere you're getting into a zone which is maybe not over expensive at least. And to that extent, probably one should start nibbling a bit, even if you don't want to put all your money in one shot. It's at least something where you want to nibble it and go ahead a bit. I think the key is going to be the earnings growth. Is it going to come back? How quickly is it going to come back? And how sluggish is it going to be?
All right. Hi, good afternoon, Mr. Jaipuria. But help us with the sectors where one should start finding out the opportunities.
There are some things, and obviously ours is a philosophy which we call the 3 U's. So we tend to look for stocks which are, undervalued, but sectors which are underowned and underperforming. So one of the sectors which we are looking at is now the banking space. And mind you, this is not something which we are pushing for this quarter or something, but over the next 12, 18 months, the reason we like the banks is they are very cheap. If you look at, banks average valuations over the last 10-year period and the average valuations today, banks is one of the only sectors which trade cheaper than what a 10-year average is. So banks are cheap. And second is, at these valuations, a lot of bad news is priced in. So as we see growth coming back, as we see things recovering, then I know banks is one sector which will do well. The other sector which we like is pharmaceutical. And that's something we've liked for like a year now. Uh, in pharma, one is we think it's like quite a secular growth story. We like the US generic space because that's a space where prices were falling. They seem to have bottomed out and probably are remaining flattish now. So you should see growth coming back. The other area we like is the CDMO space in that whole pharma pack. Now, this is a sector where, valuations is something which makes us a little uncomfortable. You want to buy it maybe at lower valuations than where it is today. But there's a lot of growth in the sector. It's something where secularly there are companies which probably could grow earnings 20% to 30% over the next 3 year, 5 year. So with that secular growth, investors can make money. They should just be careful of what valuation they're buying it at.
Okay, so pharma as well as banking, these are the two areas of interest. But Jyoti, would you say that areas like new age platform companies, the likes of Zomato, Paytm, etc., as well as real estate has topped out at least for the next 12 to 18 months?
If you take the new age platform companies, we didn't really buy them. We're not owned them for some time now. Because, in our whole philosophy of valuations, they were not fitting in. We were finding them quite expensive. Some of them have corrected. So to that extent, maybe they've become cheaper for people, but in our framework, still something we're not buying it. Real estate, is something where we think some of the ancillaries to real estate are probably more interesting than the real estate. Demand has been strong, but the feel we are getting is in the last couple of months, demand has stagnated a bit and is starting to slow down. Some of the ancillaries, like, wire and cable over there, or, uh, maybe the tile space, the ceramic space, these are spaces which we are more focused on because, if you look at the whole ceramic and the tile space, their demand has not been good, and typically demand should come with a lag after real estate does well. So we think demand will pick up in some of these areas over the next 12, 18 months, and valuations are much, much cheaper than what they are. So, we like the real estate space as such, but probably playing it more through the ancillaries now.
All right, but Jyoti also talked to us about some of these newish tech companies, specifically in the QSR space, the one which already had a lot of these investor interest. And given the correction of late, yes, the earnings did play a spoil sport there, but also at the other hand, there's a huge opportunity for growth for all these companies. So do you believe that any of these companies are at an attractive price point or valuation wise you like some of these new age tech companies?
So, over the next like years, 5 years, 7 years, some of these companies will become very big, right? What you can see is there's a total change in buying pattern, consumer behavior, and everybody's moving to the tech companies and rather than, going to shops to shop or order food or eat food. So, they will become much, much bigger. Now, if we see like the mortality rate and all these over the years, it's quite high. So there'll be it's like a winner take all model, and there'll be a couple of companies which will do very well. So one is being able to forecast that company which will do well, and it need not necessarily be the company which today sounds good, but there's a big first mover advantage in this space, which tends to sustain unless you really uh, have a problem with implementation and somewhere along the way. Uh, the only thing is that a lot of these companies tend to make losses. You need a constant round of funding, which tends to dilute the cap equity shareholders. So to that extent, for us, when we build that into our model and then we start thinking of valuations, it's like there are stuff which we can find cheaper, which probably may not give the same sort of return, but at least on a risk reward basis works out to be more comfortable. For us, in most of our stock picks, the margin of safety is very important. And that is what makes us maybe at these valuation not buy some of these stocks.
Yeah, going back to the Ben Graham principle, right? So, margin of safety clearly being very important. But just a last question before I let you go, and that's the two big themes that everyone was talking about: energy transition and EMS. Both have come under acute pressure. One is facing headwinds from the US, and one is facing uncertainty with respect to the budget propositions. Your take?
So, it's always like the themes will play out, and I think the themes will continue to play out, but it's what valuation you place. So, if you look at all the EMS companies, they're still growing and they'll probably grow strongly over the next few years. It's just that at these valuations, what are you paying already for it? Are you paying too much too soon for it? And if there is some slippages in implementation, because they work with a few companies, one company cancels their order or the sales of that company does not pick up, then there's no margin of safety over there. So basically, in principle, we like these themes. It's just that at these valuations, we struggle to find companies which we think are, a decent risk reward equation over there.
Okay, Jyoti, on that note, we'll let you go. Thanks so much for joining us. A quick break, and we'll be right back with more on the other side.
If you like this video, then like, share and subscribe to ET Now.